Silver is sitting at $77 right now, down from $121 in late January. And the number Goldman Sachs just put out, $85 to $100 per ounce as their 2026 average target, is being treated by most retail investors as if it were noise from a broken radio. Sarcastic. A distant target. Something that might happen eventually, for someone else. That's a mistake. And the reason it's a mistake is not the number itself. It's what you have to understand about the physical market, the structural supply picture, and 3 specific things that happened in the last 72 hours to understand why Goldman putting that range on paper right now is not bullish commentary. Exhales sharply. It's a late acknowledgement. Here's the number that should stop you in your tracks. COMEX, the commodity exchange in New York and the primary venue for silver futures trading globally, currently has approximately 86 million ounces of registered silver in its vaults, the metal that is actually available and warranted for delivery against futures contracts. At the same time, paper claims on that metal, outstanding futures contracts, represent a leverage ratio of 7.3 times that available physical inventory. 7.3 paper promises for every real ounce sitting in those vaults, and in the March 2026 delivery cycle alone, 10,526 contracts stood for physical delivery on first notice day, representing 52.63 million ounces. In a single delivery month, the market demanded more than 60% of the entire registered supply. That tension has not resolved. The metal is still being drained. The paper promises are still outstanding. By the time this video is done, you'll understand why silver trading at $77 today, while Goldman's own model says $85 to $100, is not a sign that Goldman is wrong. It's a sign that you're watching 2 completely different markets operate simultaneously, and that the gap between them is being forced right now by mathematics that doesn't have a comfortable resolution. The Federal Open Market Committee, the body that sets U.S. interest rate policy, concluded its March 2026 meeting yesterday. The Federal Reserve held rates steady at 3.5% to 3.75% for a second consecutive meeting. Chairman Jerome Powell's press conference acknowledged that the war in Iran has introduced elevated uncertainty into the economic outlook, that inflation remains above the Fed's 2% target, and that the implications of the Middle East conflict for the U.S. economy are, in Powell's own words, uncertain. The Fed's dot plot, the internal forecast of where policymakers think rates are going, signaled 1 rate cut in 2026, unchanged from December's projection, with the timing unclear. Here's why this matters directly to silver. Goldman Sachs Asset Management's head of multi-sector fixed income, Lindsay Rosner, said in response to the decision that the Fed retains what she described as an easing bias, and that Goldman still sees room for 2 cuts in 2026. A Fed that cannot cut rates because inflation is being pushed back up by an oil shock from a Middle East conflict is a Fed that is structurally trapped. Real interest rates, the rate adjusted for inflation, are falling even as the nominal rate holds flat. That is precisely the monetary environment in which silver has historically made its most extreme moves. Not because of speculation, because the real cost of holding the physical metal relative to holding cash improves as real rates decline. The silver spot price today is $77 per ounce. 2 months ago, it reached a nominal all-time high of $121.67 on January 29, 2026. Since then, it has sold off 36%. The 52-week range for COMEX silver futures, according to today's data, spans from $29.11 to $121.78. Goldman's $85 to $100 average target for the year means the bank's own model requires prices to return to and sustain a level roughly 10% to 30% above where the metal trades this morning. Retail investors looking at $77 and a 36% drawdown are treating this as a broken thesis. Goldman is not. The question is which understanding of the market is more complete. The London Bullion Market Association, the body that oversees the global benchmark silver price, has been the silent center of the most significant supply dislocation in modern silver market history. Goldman's own analysts, Lena Thomas and Don Struyven, wrote in a January note that London, where global benchmark silver prices are set, was left with unusually low inventories after metal was pulled into U.S. vaults throughout 2025 amid concerns about potential tariffs. The bank wrote that thinner inventories have created conditions for squeezes, where rallies accelerate as investor flows absorb remaining metal in the London vaults and reverse sharply when tightness eases. What Goldman described as a condition is not past tense. The drain is ongoing. The CME Group's own warehouse data, published daily, shows registered silver inventory has fallen 15.1% in the 30 days preceding this week. That is 14 million ounces withdrawn from the deliverable pool in a single month. The coverage ratio, the fraction of outstanding paper claims that could physically be satisfied with registered inventory, stands at 13.7%. The historical stress threshold is 15%. The market is operating below the level that has historically been associated with delivery crisis conditions, and it has been doing so for weeks. The April 2026 first notice day is 9 business days away. As of the most recent report, 1,903 contracts representing 9.5 million ounces remain open in that delivery cycle. Here's the thing. Mainstream financial coverage is not connecting to these inventory numbers. On January 1st, 2026, China, which controls between 60% and 70% of the world's refined silver supply, implemented a new export licensing regime that replaced a quota system that had been in place since 2000. China's Ministry of Commerce now requires all silver exporters to hold special government licenses issued on a 2-year basis. To qualify, firms must demonstrate annual production capacity of at least 80 tons and must prove they executed silver exports consistently from 2022 through 2024. This effectively blocks hundreds of smaller and mid-sized exporters that had been functioning as the connective tissue of the global refined silver market. When China tightened rare earth exports using a similar licensing playbook, the initial market reaction was skeptical. Within 18 months, those doubts were resolved by supply chain evidence. The silver export control is structurally identical, and the global silver market is substantially more financialized, meaning the price signal will transmit faster. According to analysts at MEXC who have been tracking the deficit data, global silver demand in 2025 reached 1.24 billion ounces against supply of 1.01 billion ounces. That is a deficit approaching 230 million ounces. This is the 5th consecutive year of structural deficit, 5 straight years where the world consumed more silver than it produced. The above-ground inventory buffer, the stockpile that was meant to absorb those annual gaps, has been drawn down for 5 years in succession. And here's the detail that rarely makes it into mainstream coverage. Shanghai Gold Exchange registered inventory declined 43% between November 2025 and February 2026, from 559 tons to approximately 318 tons. London is drained. Shanghai is drained. COMEX is at stress level coverage ratios. 3 of the world's 4 primary silver pricing hubs are simultaneously showing physical tightness. The 4th is not replenishing the first 3. This is where the hidden mechanism becomes visible. The question is not why silver is down 36% from its January high. The question is why a market with these structural fundamentals could fall 36% in 6 weeks. The answer lies in one event, the surprise nomination of Kevin Warsh to succeed Jerome Powell as Federal Reserve Chair, announced by the White House on January 30th. Warsh is publicly known as a dollar hawk. His nomination triggered what traders called the Warsh shock, a violent short squeeze in the US dollar index that sent the DXY surging, crashing precious metals simultaneously. Silver fell from above $115 to find a floor near $71 in the space of days. This is not a supply story driving the recent price weakness. This is a dollar move-driven paper market liquidation on top of a physical market that never resolved its underlying tightness. That distinction matters enormously. In 1980, when the Hunt brothers attempted to corner the silver market and COMEX introduced Silver Rule 7, which restricted buying silver on margin, the exchange itself changed the rules mid-game to halt a physical squeeze. Prices collapsed. But the collapse happened because speculative demand was forced out by regulatory action while the physical market had not actually developed a genuine industrial shortage. The situation today is structurally different in one critical way. The demand that is currently standing for physical delivery at COMEX is not speculative. According to delivery data published through February 2026, the highest delivery concentration was on first notice day itself, with the next largest spikes occurring mid-cycle. This is the timing pattern of industrial procurement, not speculation. Industrial buyers do not roll their contracts. They take the metal. You can print paper silver contracts. You cannot print the silver inside a solar panel that has already been laminated. The distinction between those two things is what Goldman's $85 to $100 target is really about. Not momentum, not speculation, mathematics. Now, the counter-argument deserves a serious hearing because it's not a weak one. The bearish case, stated honestly, goes like this. Silver sold off 36% from its peak because the dollar strengthened significantly. Inflation remains stubborn enough to prevent the rate cuts that were supposed to drive metals higher. And the supposed physical squeeze failed to prevent a massive price collapse. If the COMEX inventory stress was as severe as the bulls claim, how did prices crash through $80 and into the 70s? The answer that bearish analysts give is that COMEX delivery demand, however elevated by historical standards, was absorbed without a default, proving that the system has more flexibility than the inventory numbers imply. Eligible silver can be converted to registered, off-exchange inventory can be mobilized. The paper market is not about to blow up. That argument is fair, and it's true that the market did absorb March delivery demand without a public default or force majeure. The honest answer is that no one can say with certainty whether the April cycle will be different. The market is complex, and its participants are adaptive. But what the bearish case does not adequately address is the geological dimension. Fresnillo plc, the world's largest primary silver producer, operating entirely out of Mexico and listed on the London Stock Exchange, cut its 2026 silver production guidance on January 28th from a range of 45 to 51 million ounces down to 42 to 46.5 million ounces, a 9% reduction. The reason given in the official filing was not market conditions or price signals. It was mine plan changes driven by narrower veins and deteriorating ore grades at multiple operations, Fresnillo, Saucito, and Ciénega. Morgan Stanley analysts reviewing the filing said the company faces 5% to 9% downside risk to consensus volume estimates in 2026 and maintained an underweight rating on the stock. When the world's biggest primary silver producer cannot increase output at $80 silver because the geology has deteriorated, higher prices cannot solve the supply problem. That is what makes this cycle structurally different. There are 3 specific things to watch over the next 24 to 72 hours that will tell you which direction this resolves. The first is today's CME Group Daily Vault Report, which will be published after market close. If registered silver inventory continues to decline below the 86 million ounce level that was already a multi-year low, the April 1st notice day, which arrives in 9 business days, faces arithmetic that becomes increasingly difficult to manage without significant eligible to registered conversions. Watch for any registered inventory number below 83 million ounces as a structurally significant data point. The second is the DXY, the US dollar index, which has been the primary driver of silver's paper price over the past 6 weeks. With the Fed holding rates yesterday and the dot plot still signaling one cut in 2026, the dollar's short-term direction hinges on how the oil market interprets the Iran situation. Brent crude was trading above $104 per barrel as of this morning's FOMC session. If oil pulls back on any diplomatic signal from the Middle East, dollar strength could ease and silver's paper price would likely recover. Watch $100 oil as the threshold. If Brent stays above that level through the end of the week, the stagflation narrative that Goldman Sachs and others have identified, where inflation rises but the Fed cannot act, remains intact and structurally favorable for real assets. The third watch point is China's SGE, the Shanghai Gold Exchange, which will publish its weekly inventory report. The last reported figure was approximately 318 tons, down 43% from November. If that number drops below 300 tons, you are watching 3 of the world's 4 major silver pricing hubs simultaneously at multi-year or multi-decade inventory lows. That is not a scenario the London Bullion Market Association or CME Group have a playbook for. Here's what the evidence, taken together, actually shows. Goldman Sachs' $85 to $100 target is not an aggressive call, given what the physical market data confirms. It's a moderate call. Bank of America's Metals Research has issued forecasts projecting silver prices between $135 and $130 per ounce in 2026. Citigroup has independently issued projections of $150 per ounce, citing relentless Chinese physical demand and the structural supply deficit. These numbers come from the same institutions that hold significant positions in the futures market. When major banks publicly revise price targets upward during a period of inventory stress and supply guidance cuts, their internal models have already shifted. The public announcement follows the private repositioning. The retail investor who looks at $77 silver today remembers $121 silver in January and concludes the bull market is over is making the same error that was made in 2008 when silver dropped from $20 to $8 during the financial crisis before rallying to $48 by 2011. The structural deficit did not disappear in those drawdowns. The physical reality did not change. What changed was the paper market's relationship to leverage, liquidity, and sentiment, all of which are temporary. What does not change is the geological fact that the world's largest primary silver producer just told the London Stock Exchange that its mines are producing narrower veins and lower ore grades. What does not change is that China locked 60% to 70% of global refined silver supply behind a licensing wall on January 1st. What does not change is that global silver demand has exceeded global silver supply for 5 consecutive years, and the inventory that was covering that gap is measurably thinner today than it was 6 months ago. The synthesis that the data points to is this. What the market is currently pricing is a paper market response to dollar dynamics and rate uncertainty. What the market has not yet priced is the compounding effect of simultaneous inventory depletion across London, Shanghai, and COMEX, a geological supply constraint that cannot be resolved by price signals alone, and a Chinese export licensing regime that has structurally reduced the global flow of refined silver, regardless of what futures contracts say. Goldman did not raise its target to $85 to $100 because it believes in momentum. Goldman raised it because the structural math, when modeled honestly, does not support prices significantly below that range for an extended period, given the physical conditions on the ground. Here is the question I'll leave for the comments section. Given that COMEX registered inventory has already fallen below 86 million ounces and April 1st notice day arrives in 9 business days, where do you think registered inventory stands by the time April's delivery cycle is complete? Drop your number in the comments. If you have data from your own tracking of CME warehouse reports that contradicts or supports what's been laid out here, I genuinely want to see it. The most analytically rigorous response I'll pin. The next CME Vault report publishes tonight. I'll have the April 1st notice day analysis up before market open that morning. Subscribe with notifications on if you want it when it drops. This one is time sensitive. Everything in this video is sourced from public data. CME Group Vault reports, Goldman Sachs analyst notes published through investing.com, LBMA public documentation, Fresnillo's official production guidance filed January 28th, Federal Reserve FOMC statements and dot plot projections from yesterday's meeting, and silver spot price data from JM Bullion and APMEX. I'm not a financial advisor, and nothing here is investment advice. Every number cited is publicly verifiable. The links will be in the description. Verify the data yourself. Make your own decisions.